Here's a scenario I want you to think about. Two investors. Same age. Same income. Same ETF, let's say VDY, one of Canada's most popular dividend ETFs. Same amount invested. Same holding period. At the end of the year, one investor receives a tax bill of roughly $4,000 on their distributions. The other investor's tax bill for the same distributions is under $800. Same investment. Dramatically different outcome. The difference? Account placement. One investor held VDY in the wrong account. One held it in the right account. This is what we're talking about today, how to minimize the tax drag on your Canadian dividend ETFs by understanding how different types of income are taxed, and which account type is optimal for each. By the end of this video, you'll have a clear, actionable framework. And you'll probably want to review where your current investments are sitting. Let's start with the basics. Before we can talk about account strategy, we need to understand how different types of investment income are taxed in Canada. This is fundamental. There are 4 categories. Category 1, eligible dividends. This is income paid by Canadian public corporations out of their after-tax profits. When a Canadian bank like RBC or a pipeline like Enbridge pays you a dividend, that's typically an eligible dividend. Now here's the important part. Because the corporation has already paid corporate tax on those profits, the government gives individual investors a credit, called the dividend tax credit, or DTC, to avoid taxing the same dollar twice. The mechanics involve grossing up the dividend by 15%, declaring the higher amount as income, and then claiming the DTC against your tax payable. The net effect is that eligible dividends are taxed at a significantly lower rate than ordinary income. At the top Ontario bracket, eligible dividends face an effective tax rate of around 39%, compared to over 50% for salary. At lower income levels, the tax rate on eligible dividends can be near zero, or even negative, meaning you actually receive a credit. This makes eligible dividends one of the most tax-efficient forms of investment income available to Canadians in a non-registered account. Category 2, capital gains. When an asset is sold at a profit, the gain is a capital gain. In Canada as of 2026, individuals include 50% of capital gains in taxable income, the so-called 50% inclusion rate. Note, a proposed increase to 66.7% for gains above $250,000 was announced in 2024 but was cancelled by the federal government in March 2025. The rate remains at 50% for individuals. At the top bracket in Ontario, the effective tax rate on capital gains is approximately 27%, again, significantly lower than ordinary income. Category 3, Return of Capital, ROC. This is where many investors get confused. Return of capital distributions are not taxed when you receive them. So in the short term, they look like the most attractive option, you get cash, and no tax bill. But here's the catch. Every dollar of return of capital reduces your adjusted cost base, your ACB. The ACB is the cost basis the government uses to calculate your capital gain when you eventually sell. So if you paid $10 per unit, and over the years you receive $2 of return of capital, your ACB is now $8. When you sell for $15, your capital gain is not $5, it's $7. The ROC wasn't tax-free. It was tax-deferred. And here's the part that catches people off guard. If you've held an ETF for many years without tracking your ACB adjustments, you can arrive at the point of sale with a much larger capital gain than you expected. This is not a reason to automatically avoid ETFs that distribute some ROC. But it is absolutely a reason to track your ACB carefully, and to be skeptical of ETFs where ROC represents the majority of distributions. Category 4, Option Premiums and Foreign Income. This category is the most punishing from a tax perspective. Income generated from selling covered call options is generally treated as ordinary income in Canada, fully taxable at your marginal rate. At the top Ontario bracket, that's over 53%. Foreign dividends, income from U.S. or international companies, are also taxed as ordinary income, with an added complication. The foreign country typically withholds 15% at source, and getting credit for that withholding depends on the account type. Covered call ETFs generate most of their high yields through option premiums. That's why their apparent yield comes with such a heavy tax penalty in non-registered accounts. You might see a 12% yield, but but after tax at the top bracket, you're keeping somewhere around 5 to 6%. Meanwhile, a 4% eligible dividend yield might net you 3% or more after tax, a much better ratio. Let's put those numbers side by side so you can see how dramatically account type and income type interact. Now let's look at our 3 account types and what they mean for tax treatment. The TFSA, Tax-Free Savings Account. Inside a TFSA, all investment income is completely tax-free, regardless of its type. Eligible dividends, capital gains, return of capital, option premiums, none of it is taxed, ever. The 2026 cumulative contribution room for someone who has been eligible since 2009 is approximately $102,000. The TFSA sounds like the obvious place for everything. But it's a limited resource. The question is, what goes inside it to generate the most tax-free value? The RRSP, Registered Retirement Savings Plan. RRSP contributions reduce your taxable income in the year you make them. Everything inside grows tax-deferred. When you withdraw, the amount is taxed as ordinary income. The RRSP has one specific and significant advantage: the Canada-US Tax Treaty. U.S.-listed securities held in an RRSP are exempt from the standard 15% U.S. withholding tax on dividends. That exemption does not apply to a TFSA or non-registered account. The non-registered account: in a non-registered account, you pay tax each year on income as it's generated, at rates determined by income type. This is where the difference between eligible dividends and ordinary income matters most, and where smart asset placement creates the most value. This is the most important section of this video. And it's a mistake I see regularly. Many Canadian investors hold VDY, XDIV, or XEI inside their RRSP. It feels intuitive: these are long-term holdings, the RRSP is a long-term account, so it makes sense, right? It doesn't. Here's why. VDY and XDIV distribute primarily eligible dividends. In a non-registered account, those eligible dividends benefit from the dividend tax credit. At a middle income level, the effective tax rate might be 15 to 20%. At a lower income level, possibly near zero. When you hold those same ETFs inside an RRSP, the dividend tax credit disappears. When you eventually withdraw from your RRSP, every dollar comes out as ordinary income, taxed at your full marginal rate, which might be 30, 40, or even 50%. Let's make this concrete. You hold $100,000 of VDY in your RRSP. It pays approximately $4,500 in distributions this year. When you withdraw that money in retirement at a marginal rate of 30%, you'll pay about $1,350 in tax on that $4,500. If you had held that same VDY in a non-registered account and you're a mid-income earner, the dividend tax credit might reduce your effective tax rate on those eligible dividends to around 15%, about $675. The RRSP costs you more, not less, on this specific type of income. The RRSP is not a universally superior account. It is the optimal account for specific types of income, and eligible dividends from Canadian companies are not on that list. Let me now lay out the optimal framework clearly. TFSA, put your most tax-inefficient, highest growth assets here. Covered call ETFs like QQCC, whose distributions are primarily option premiums taxed at full marginal rates in a non-registered account, are ideal TFSA holdings. You completely eliminate the worst tax treatment. High-growth equity ETFs that will compound significantly over time also belong here, because you want the largest future value to be sheltered. What doesn't make sense in a TFSA? Assets whose income is already tax-advantaged, like eligible dividends. Holding VDY in a TFSA works, it's tax-free, but you're not maximizing the value of your TFSA room. One important caveat: U.S. dividend-paying assets held in a TFSA are still subject to 15% U.S. withholding tax, and you cannot recover that withholding. RRSP, put your U.S.-listed assets here. The Canada-US Tax Treaty exempts RRSP holdings from the 15% U.S. withholding tax on dividends. This exemption applies only to the RRSP, not the TFSA, not non-registered accounts. If you hold a U.S. S&P 500 ETF like VFV or XUU, or any U.S. dividend-paying stocks, the RRSP is the only account where you can receive those U.S. dividends without the 15% withholding. Non-registered, put your Canadian dividend ETFs here. VDY, XDIV, XEI, ZDV, these belong in non-registered accounts where the dividend tax credit applies. Yes, you pay tax annually on distributions. But you pay the tax at a significantly reduced rate compared to ordinary income, thanks to the DTC. Here's the full picture at a glance. Let me take a moment to specifically address the adjusted cost base issue, because it catches investors off guard more often than almost any other tax topic. If you hold an ETF that distributes any return of capital in a non-registered account, here is exactly what you need to do. Every year, when you receive your T3 tax slip, look at box 42, this is the return of capital amount. Subtract that number from your ACB per unit. For example, you bought 1,000 units of an ETF at $10 each. Your initial ACB is $10,000. In year 1, you receive 50 cents per unit in return of capital, $500 total. Your new ACB is $9,500. In year 2, another 50 cents per unit. ACB is now $9,000. 10 years later, your ACB might have dropped to $7,000, even if the unit price hasn't changed. When you sell at $10, you have a capital gain of $3,000, not zero. If you haven't been tracking this, you may owe more tax than you expect. The Canada Revenue Agency expects you to report the correct ACB, regardless of whether your brokerage calculates it for you. Some brokerages do track ACB automatically. Others do not. Know which category your brokerage falls into. Let me walk through a practical scenario to illustrate how this all works together. Say you have $200,000 to invest. You want core Canadian dividend exposure through XDIV, and you also want some U.S. equity exposure through VFV, a Canadian-listed S&P 500 ETF. And let's say you have $80,000 of TFSA room available, and $70,000 of RRSP room. Here's the optimal placement. RRSP, put your VFV exposure here. The U.S. withholding tax exemption applies, preserving your full return on U.S. dividends. Use up to $70,000. Non-registered, put your XDIV here. The eligible dividends benefit from the dividend tax credit. Your effective tax rate on those distributions will be significantly lower than ordinary income rates. Use the remaining funds here. TFSA, if you have more TFSA room, prioritize whatever generates the most tax-inefficient income, option premium income, high-growth assets with significant unrealized gains, or foreign income that doesn't benefit from treaty exemptions. The result of this placement strategy, over 20 years, compared to simply putting everything in the first account you opened, can easily represent a difference of $30,000 to $50,000 or more on a portfolio of this size. Let me recap the 3 rules that should guide your account placement. Rule 1. Canadian dividend ETFs, VDY, XDIV, XEI, belong in non-registered accounts. The dividend tax credit makes eligible dividends tax efficient there. An RRSP actually makes things worse for this type of income. Rule 2. U.S.-listed assets belong in the RRSP. The Canada-U.S. treaty withholding exemption is a guaranteed, permanent return enhancement that only applies in an RRSP. Rule 3. Tax-inefficient assets, covered call ETFs, high-growth positions, belong in the TFSA. Maximize the value of your tax-free room by sheltering income that would otherwise face your highest marginal rate. And one final reminder, if you hold any ETF with a return of capital component in a non-registered account, track your ACB. Do it every year. Do not rely solely on your brokerage's calculations. The tax liability is real, and it grows quietly over time. This is the 3rd and final video in our Canadian Dividend ETF series. If you're joining us here, I'd recommend watching the first 2 videos as well, the links are in the description. If this series was useful, please like, subscribe, and share it with someone who's building a dividend portfolio. And drop your questions or topics in the comments, I'll address the most common ones in future videos. Thank you for watching. See you next time. This video is for educational purposes only and does not constitute investment advice. Tax rules are subject to change. Please consult a registered CPA or financial advisor for guidance specific to your personal situation.